The last 2 weeks, we've seen monetary policy meetings from all four of the big central banks in the developed world. So this week, we're going to take a look at where the markets think interest rates are going for the rest of the year and where we differ on that outlook. And we'll start with the US. The new president, well, he certainly stirred things up with frenetic policy announcements. But despite that, we still see the macro outlook there as reasonably settled. Growth is steady, pretty good, but it's at a Goldilocks pace. That's not too strong to push up inflation, but strong enough to keep the economy well clear of recession. Indeed, we think inflation will continue to improve there. Now, this week we get the CPI release, and that'll provide an update, and any difference between the outturn and what the market expected will certainly see a big reaction. But the greater picture is of a gentle decline in US inflation back towards the 2% target. Both rental inflation and wage inflation are slowing, and they are the most powerful drivers beyond the month-to-month fluctuations. Well, how can you say that, I hear you say, when you've just had figures for the closely watched payroll report showing a rise in average hourly earnings? Well, I suggest you just ignore those figures. They're distorted by compositional effects. In this case, there's a shorter working week due to fires in Los Angeles and bad weather elsewhere, and that mathematically raises the average per hour for salaried workers. And I'm not too worried about tariffs either. Even if Trump imposes the most comprehensive tariffs, they won't apply to all imports, which are anyway a small share of GDP and an even smaller share of consumer spending. And the Fed can look through these one-off effects. Now, overall, the market expects just 38 basis points of cuts from the Fed by year end. We think the number will be bigger, perhaps even closer to 100 basis points, and that would still leave rates above what they consider to be a neutral level. Last week, the Bank of England cut by 25 basis points. Now, that was widely anticipated, but the market reaction initially, at any rate, that was dovish because two members voted for a bigger cut and no one on the committee voted to keep rates on hold. Well, we would discount the two dissenters and note that the Bank of England have raised their near-term inflation forecast significantly, despite cutting that for growth too. Yep, stagflation indeed. Hopes of many that Rachel Reeves' first budget would actually boost growth in the near term, well, they seem to have been dashed. And we agree with the Bank of England's outlook. Eventually, the weak economy will push inflation back down, but this will take time. And the market expects the next cut in May, with 62 basis points in total for the rest of the year. Well, we think the next few months will be distinctly unsettled for the UK and believe the Bank of England should keep rates on hold. And it may be late into this year or well into 2026 before we get more significant cuts. But by then, we think rates will have fallen below general market expectations. The outlook for the Eurozone looks distinctly more settled. That's certainly what the market think. They have a 100% probability that the ECB will just deliver another 25 basis points cut at their next meeting in March. And they see a total of 88 basis points cut in cuts over the rest of the year. That would take the overall rate down to a level of just 1.8%. Now, that's a distinctly possible scenario, but if you think about the odds of where we might be wrong, I think the chances do favour fewer cuts rather than more cuts. Meanwhile, the BOJ, they bucked the trend with a rate rise at their most recent meeting with the prospect of more increases to come. And that's because they're emerging from lost decades of deflation and their rates are still lower than all the other major central banks. So what does all this mean for markets? Well, leaving Japan aside, interest rates are coming down, and that's good for risk assets. But all the uncertainty and genuine damage from Trump's tariffs and other policies, and that goes the other way. In terms of asset allocation, we don't think this is time to take large positions. No time to be a hero. We're modestly overweight equities and generally neutral elsewhere. Okay, until next week, goodbye from me.